On August 1, 2012, one of the largest trading firms on Wall Street was destroyed by a piece of software nobody had used in 7 years. At 8:01 in the morning, Knight Capital's own systems sent 97 automated messages identifying a critical error in its trading software. The Securities and Exchange Commission later found that Knight Capital did not act on them. The market opened at 9:30. In the 45 minutes that followed, Knight Capital lost $440 million. That figure is not from a lawsuit or from a regulator's estimate. It is from Knight Capital's own filing with the SEC submitted in the following morning. The company was effectively destroyed before lunchtime. Knight Capital Group was not a bank, it was a market maker, a firm that stood permanently ready to buy or sell stocks at any moment, providing the liquidity that allowed everyone else to trade. When you wanted to buy shares in a company listed on the New York Stock Exchange, there was a reasonable chance Knight Capital was on the other side of that transaction. Multiple reports at the time put Knight's share at roughly 1 in 6 trades on the New York Stock Exchange. 1 in 6 trades running through one firm's systems. Knight Capital was not a participant in a market, it was a market maker. The firm on the other side of your trade when nobody else was available. Remove it suddenly, and the question is not whether the market notices. It is whether the market can keep moving at all. The sequence of events that destroyed Knight Capital began, as these things often do, with a routine software update. In the summer of 2012, the New York Stock Exchange launched a new program called the Retail Liquidity Program, a mechanism designed to offer individual investors better pricing on their trades. To participate, Knight Capital needed to update its trading router, SMARS. This was a system that took large orders, broke them into smaller ones, and sent them into the market. In late July 2012, Knight's engineers deployed the new software across 8 SMARS servers. 7 were updated correctly. 1 was not. According to the SEC's administrative order, a technician failed to copy the new code to the 8th server. That server was still running an old piece of code called PowerPeg, a function Knight had moved to an earlier point in a router's code sequence in 2005, rendering it defective and never removed. The new deployment repurposed a software flag that PowerPeg also recognized. When that flag was activated on the 8th server, it did not run the new Retail Liquidity Program code. It ran PowerPeg instead. The wrong code on one server in a system moving thousands of orders per second. The SEC's order found the defective function was unable to recognize when orders had been filled. It continued sending orders into the market without limit. Like a light switch that used to operate one circuit and has been rewired to operate another. In 7 rooms, the rewiring worked correctly. In the 8th, nobody rewired it. When you flipped the switch, the old circuit activated, the one nobody had used in years, the one with no off switch. At 8:01 in the morning, Knight's own systems generated 97 warnings. Not one acted on. According to the SEC's order, the messages referenced Mars and were received by Knight personnel. They were not designed as system alerts. At 9:30 a.m., the New York Stock Exchange opened. Knight's system received 212 customer orders at the open, routine retail trades. On 7 servers, those 212 orders were processed correctly. On the 8th, PowerPeg activated. Over the next 45 minutes, that single server sent more than 4 million orders into the market across 154 stocks, executing more than 397 million shares. Figures the SEC's order documents in detail.
Knight accumulated a long position of approximately $3.5 billion in 80 stocks and a net short position of approximately $3.15 billion in 74 stocks. In plain terms, Knight was now holding roughly $6.65 billion worth of stock it had never meant to buy or sell.
In its own filing the following morning, Knight stated the loss had, in its words, severely impacted the company's capital base. The pre-tax loss, as reported in the same filing, was $440 million. When Knight moved to unwind its positions, it did so in a market that already knew Knight was selling. The majority of the erroneous trades were not cancelled. The counterparties had traded at prevailing market prices. The trades stood. The $440 million was not just the cost of the error. It was the cost of unwinding it under the worst possible conditions, with every market participant watching. Knight's share price fell sharply in the days that followed. On August 5th, a consortium of investors provided emergency financing of approximately $400 million in convertible securities, instruments that would convert into equity, significantly diluting Knight's existing shareholders. In December 2012, Knight agreed to be acquired by Getco LLC. The merger was completed in July 2013, forming KCG Holdings. Knight Capital, as an independent firm, ceased to exist. In October 2013, the SEC issued an administrative order finding that Knight Capital had violated the market access rule, a regulation requiring broker-dealers to maintain controls sufficient to limit the risks of erroneous orders. Knight agreed to pay a civil penalty of $12 million. Here's what the public record shows. Knight Capital's own systems warned it something was wrong at 8:01 in the morning. The market opened at 9:30. In the 45 minutes that followed, a firm responsible for 1 in 6 New York Stock Exchange trades lost $440 million because one server out of 8 had not been updated, and a piece of code that had been defective since 2005 had never been removed. The SEC's administrative order documented the absence of written deployment procedures, the absence of peer review requirements, and the absence of any mechanism capable of detecting an order routing system that had stopped functioning as intended. It also documented that 97 warning messages had been generated before the market opened. The rescue that saved the firm cost the firm. The acquisition that kept it running ended its existence as an independent entity. The SEC fine was $12 million. The loss was $440 million. Make of that what you will.